Hi, this is Terry, and we're doing Chapter 12, our investments chapter. One of the first issue, I guess, or topics is a classification issue, and we'll talk about trading available for sale and held to maturity. But what we're looking at is from our asset or our investment category, we can have short-term, which are also known as marketable securities, and we can have long-term securities. So when we buy securities in other companies, such as we buy their bonds payable, which would be long-term, or that we buy shares of common stock. We might be a Chicago Tribune, so we buy shares of stock in another company so that we get preferential treatment, we get good prices, and we can also guarantee that we're always going to get paper if we buy forests and paper mills, etc. When those securities, whether they're short-term or long-term, when we go out and buy them, then it's up to management to explicitly state the intent of those securities, and that's where the classification issue comes in. We have to declare whether they're trading, available for sale, or held to maturity. Trading securities, then, is when somebody is playing the stock market. So they're going to buy debt, which is your liability, your bonds payable, etc., or equity securities held with the purpose of trading them in the short term. So you're playing the stock market, you're willing to buy and sell them when the market's good, you're just taking your excess cash, and the company's willing to take on more risk, so they are buying and selling and trading these securities, just trying to increase the income of the or value of the company. Available for sale is the middle of the road. That is trading securities is the one end of the spectrum, held to maturity is the other end of the spectrum. So if we buy treasury bills, and they're 120-day treasury bills, so we go out and buy those. If the intent of management is to hold them to maturity, then we use a different method to record those securities. Available for sale, then, again, is the middle of the road, that if they're not going to be traded on an ongoing basis, and we're not overly sure that we're going to hold them to maturity, then by definition they're available for sale. So what we want to look at is then, how do we account for these securities? Well, if the amount of securities that we buy is less than 20%, then we have to use the cost method, and we'll make these adjustments to a special account called unrealized gains and losses. What makes them unrealized is the fact that it's a paper loss based on time, and it is not a loss because we sold the securities. We're holding them, and this is a new legislation for the accounting world. It didn't used to be that way. They were all lumped into one, and the idea here is when we can record these gains and losses, those are the short term or in the current counting period. So gains we would have to treat and pay taxes on as if they are revenues, and losses then decrease our net income, so we pay less taxes. If we own between 20 and 50%, then we have to use the equity method for recording the net income and the dividends that we would receive from these investments, because at that point they considered that you have influence. So that percentage itself is what gives you the influence. The 50% then is for consolidated financial statements. That becomes a parent subsidiary, and the subsidiary, when you own more than 50% of it, then you take their financial statements, combine them into the parent company, and create these consolidated financial statements, which is a whole 16-week course unto itself. All right, so what we want to look at is the first one was trading securities. So let's say that we go out and we buy $1.2 million in investments in a company or multiple companies, and we pay out cash. We hold those stocks, we hold those investments, and we originally paid $1.2 million, but now the stock market has changed, and the opening up the financial papers, and at December 31st we look at what's the closing value. We see that what we own is worth $1,120,000. In other words, at the end of our fiscal year, we have lost $80,000. Our stocks have devalued. Well, the IRS allows us, the accounting world allows us to then record an unrealized loss of $80,000. That loss then goes on the income statement, and we pay less taxes. And again, it's unrealized because we have not sold them. We're holding them. They have just devalued. The push then is that the allowance to adjust short-term investments to market account then absorbs that $80,000. So we would show on our balance sheet investments of $1,200,000 less the allowance to adjust short-term securities to market of $80,000, and now we would have that net market value of $1,120,000. So we would be displaying these on our balance sheet at the market value because we put money into that contra allowance account. Then if we go out and buy or sell any of these securities, then we would record the cash that we received. We would take the dollar amount that we paid out of the investment account, and then if we sold them for a loss, then we'd have a realized loss on sale or a realized gain on sale. And that would be when we actually sold off those securities. Let's say then, and again, I guess backtrack here for just a second, this unrealized loss is going to be done at the end of our fiscal year. This transaction will be whenever we physically sell those securities. Then at the next year, we have a different composition in our account because we've bought and sold our different securities. Then we go look and say, okay, with the securities that we now have, we have $1,028,000, but the market has gone up and we now have $1,066,000. So during that period, we have a $38,000 gain. So if we go look in our allowance account, we had just shown an $80,000 credit. Now we need to have a $38,000 gain, and the issue becomes that we have to put $118,000 for us to show the movement that we went at an $80,000 loss to a $38,000 gain. So we've moved from negative $80,000 to positive $38,000. So our investments have made a swing of $118,000. Therefore, we have to record that unrealized gain on investments $118,000. We put the debit into the allowance account so that the ending balance becomes what the difference is between our market and our cost. All right? So again, what you're looking at is that swing of $118,000. The second method then, so method number 2, is the equity method, and that's when we physically own between 20 and 50% of the shares. So in your book, they have an investment in Quay Corporation that represents a 40% interest. So when we would go buy the shares, we would debit the investment account and we would credit cash for $180,000 here. Then two issues that arise is, how do we record when the company has, the Quay company has income, And how do we record when the Quay company sends us a dividend check? And the answer is that because we're under the equity method, right, the equity method, then we need to debit the investment account for if the Quay company, Quay Corporation has an $80,000 net income and we have equity of 40% of that, then we would record in our investment account on our books a debit to $32,000 and then a credit to income. That income to Quay Corporation is a revenue account that we have to record on our books as if we made the money. And again, this all happens because we're under this equity method. Then when we get a check, a dividend check, and let's say that the Quay company distributes $20,000 and we own 40% of that $20,000, then what we have to do is record that we received a check for $8,000, so we have the cash, but that decreases our investment in the Quay Corporation, because when the Quay Corporation distributes that $20,000, they are distributing equity. Therefore, we need to reduce our investment account because the company is actually worth less because they distributed that their equity, because they distributed those dividends. Okay. Anything to do then with the consolidations, just skip that. Again, that's a whole other course unto itself. And we get to the third section. The third section then is held to maturity securities. So if we would go out and buy 120-day, $100,000 Treasury bills, we would give the government $97,000, and we would record in our short-term investments $97,000. That $3,000 is the revenue, or the interest revenue that we're going to make because we're loaning the government some cash, some money. But what we have to do on December 31st for our accrual is, because of the matching principle, we have to make sure that we record that in that length of time, in 1 month or 30 days, 30 out of 120, right, is a third. We have to, fourth, 3, 6, 9, 12, 1/4, sorry, of that $3,000, so we have to record $750 of interest income, right? Again, because of the matching principle, we have to record that income, but we're not going to receive cash, right? Because they're not going to pay it. So what we do is debit the short-term investment account. Then later, on the 31st of March, when we actually get the money back from the government, then we have to record the other 3/4. I got my fractions right here. We have to record the other 3/4 as income, so that goes into the next year. This accrual then would have been, say, 08, and now 09. Again, the matching principle says we've got to get that income in the proper time period. Then we take the money out of the short-term investments that had that $750 that we had previously added to it. So we take the short-term investment out, record the additional interest income, and then, of course, the fact that the government wrote us a $1,000 check. All right? Hope these help.